thanks everyone for attending. This is a great conference, and I feel like we should have our flower crowns or something at
I
this
was going to bring them.
Lollapalooza of a conference going on. So we'll go ahead and jump right into it. We've got a lot to talk about in a short amount of time, but thank you to all the panelists for being here, and this should be a good discussion. So first of all, love the title of this session, and the fact that they managed to put poison and panacea in the title, I think is something that we should address first. So when we talk about the term alternatives, it's a very broad categorization of a lot of different strategies and asset classes. Maybe we could start with you, Brandon, and work our way back. Just talk about alternatives as a concept, and particularly, how do you think about fitting that into an overall portfolio?
Yeah, well, I'll give you a little background. So I'm a Texas-based registered investment advisor. My partner Doug and I run a firm called Requisite. We were at UBS for 15 years and then started Requisite 5 years ago based out of Dallas. And whether we are at UBS or here at Requisite, we don't even use the word alternative because I think it's incredibly confusing because it's like alternative to what? Alternative to bonds, to stocks, to performance. And so the way we look at alternatives is really, what are you trying to solve for? And so if you're trying to solve for yield, even right now with the 10-year treasury or the 2-year treasury at what, 3.5, the 10-year around 340, you're still going to grow poor safely in bonds. So if you want to solve for yield, then we look for alternatives. And so we try to drill it down to that client having a blank piece of paper. What are you solving for? And if we can't do it in the public markets, then we'll look to the mosaic and the basket of private investments, which really is what we call them, because we look at it as either you have liquid or illiquid. We'll get to what's in between, but we look at liquid and illiquid. And if you're going to tie your money up, you better have a really good reason. And then I'll stop there, and then we'll keep going.
All right. Abby?
Yeah, hi, thank you. So I would say that at Case, we consider traditional alternative investments those that are private market investments. So there are a lot of new wrappers and structures that are popping up every day. Interval funds, 40 Act funds, different wrappers around them. We don't consider those true alternative investments. So that's just how we categorize. And I would say, I joined Case 10 months ago, and if I thought it was poison, I definitely would not have made that decision. I see it as a huge opportunity for advisors to be able to serve their clients more holistically.
Great. Phil?
So I guess starting on the poison side, I would say like any investment, it can be poison. It could also not be. I think it's too much of a generalization, and I think it's a really tough area to generalize about. I think, like you said, Brand, like the word alternative doesn't really mean anything. It tells you more about what something isn't as opposed to what it is. Like we're here at this beautiful conference called Future Proof. I would say this is an alternative advisor conference, and so far so good. I think everybody would agree. This is a great alternative. Now, Firefest, on the other hand, was an alternative music festival, and that was poison. So
you know what? We have a little group chat going on with our employees that are here, and I named it Fire Festival because we weren't really sure how this was going to go. But
wow, wishful
so
thinking.
I think really ultimately it boils down to you can't just say alternatives good or bad. It's about what are the client's objectives, what are their preferences, what are their constraints, and then building a portfolio around that. And then will include some traditional investments as well as potentially some alternatives, but there's going to be certain restrictions that people have around liquidity or other issues that might limit or kind of keep certain things off the menu, if you will. But on the other hand, they're also not a panacea. There's no silver bullet asset class that you can put in a portfolio and it's going to like solve all of your problems. They all have drawbacks, and so I think it's important to create an ensemble of non-traditional strategies as opposed to trying to find one thing that is going to fit that panacea moniker.
Right.
And just a little plug, like he's written a book on alternatives. So I don't know if you have it here with you, but if you don't, then you should.
There may be some copies sometime later this week available. So
awesome.
Well, Phil, I want to stick with you a little bit because you have written a book on this stuff, and I think one of the striking images and something that we've talked a lot about is your periodic table of alternatives, and I wish we had a visual for it, but we don't. So check out the book because it's in there. But I guess taking more of a goals-based approach of, again, what are you trying to accomplish? How do you start to categorize a lot of these esoteric strategies and asset classes and this kind of broad umbrella of alternatives into those different categories that clients are ultimately trying to solve for?
Yeah, I think again, it depends. Are you looking for capital appreciation or growth, or income, or inflation sensitivity, or just general kind of non-correlation to, major markets, or capital preservation? So depending on that, that's why I like the visual of the periodic table, because it kind of breaks things down into its most basic form, and that's like if you combine together different chemical elements, you get different compounds, and same with a portfolio. You combine together different assets, different strategies, you get different results. And so really it's about trying to find what does this client need to achieve their objectives, and let's try to back into what we can do to solve for that.
Right. And Abby, maybe a question for you. So you've got this broad view of a lot of different advisors that are trying to do a lot of different things and getting them access to those true alternatives. I guess how do you, or how do generally advisors kind of look when they are when they're actually ready to make that step into the illiquid true alternatives? How do you see them kind of thinking about those allocations, maybe more from a goals-based perspective?
So I think that every advisor is, like a snowflake, as they say. All are very different, and each of their clients are very different. So no one advisory business looks exactly like another one. So they're all very different in the ways that they invest for their clients. I would say that for me and for Case, our mission is to lead with learning. So it's really making sure that the advisor understands the asset classes, the foundations of alternative investments, the asset classes that are available to them, and then they also have access to courses on each one of the products that are on the Case platform. So we really do lead with learning to make sure that the advisor really understands what is this product. They can feel confident around their understanding of the product and how it fits into the portfolio, and where they might want to supplement it in a sleeve in their client's allocation.
But one thing on that, where we're asset allocators, we're allocating to our clients across the firm, is that you can know a strategy and know merger arbitrage, or know convertible arb, or statistical arb, or whatever. And that's level one, because you can do that really easily in the public markets and have the experience of that asset class, right? Because in the public markets, like over the last 10 years, the delta between the best performing large cap growth and worst performing was 2% per year. The delta between VC managers the last 10 years was 30% a year. Like, what? That's crazy. And so you can educate yourself about VC, but in the private markets, whether it's a liquid alternative mutual fund or a VC fund, you're betting on the jockey. And so I just think that is just step one, because
Totally
ultimately
true.
we don't allocate to strategies, we allocate to people.
Yeah.
In the public markets, we allocate to strategies with low-cost ETFs, because that's easy to do, and we're going to get the return of that asset class. And I think that's the poison, is that too many people say, well, I want to own VC, and you just go through this library of different VC managers and go buy it. And that's where I would just say, well, why don't you just go buy a basket of beaten down publicly market traded stocks that probably act like VC, than try to lock up someone's money for 10 years when you don't even know who the manager is or what they're doing.
So you raise a really good point, and just one thing, and then I'll pass it back over, but that's why all of our funds on the Case platform go through Mercer's due diligence. So we have our own due diligence team, but if it doesn't pass the Mercer sniff test, it does not get on the Case platform. And they do not only regular due diligence, they do operational due diligence as well. So the intense scrutiny that they go through to even just pass the test before they get on our platform, they raise a really good point there.
Bryn, maybe just sticking with you a little bit on that dispersion, which I believe the technical term is you can drive a truck through it.
Yeah.
Just leave that where that is. But I think when a lot of people think about private markets and illiquidity, they immediately think about this illiquidity premium, that just by investing in this stuff, there's somehow 300-400 basis points of excess performance that comes from locking your money up. But I think both Abby, you and Bryn have both raised this point of the dispersion of those managers kind of shows that you don't automatically get that premium just for locking your money up. So could you talk a little bit about that?
I think if you're not really going to take the time to get to know the manager or have an iCapital or a Case or a great platform that is going to do a lot of that for you, I think the premium is you're going to get fired by the client because you don't know what you're doing. And the other thing is, like, we do mostly, and Phil and I talked about this, we do on Requisite mostly K1 investments because our clients are qualified purchasers. And so our clients already have 10, 15, 20 K1s. But what you don't want to do is be the advisor that you are their only K1, because that's irritating to a client. And so that's where I think from knowing your client, and Phil and I were talking about this, is about we have the ability to say we can do accredited or QP because the clients qualify and they already have a dozen K1s. But if not, I think that also needs to be your decision strategy if you're going to engage in alternatives, is realistically, what is your client base? Because you want to give a good experience for them, not to irritate their CPA and you. And so I think there's some wonderful investments that are accredited that you don't have to be on the K1 side, but that's something you need to think through as you're wanting to embrace more illiquid investments.
There are operational challenges for sure.
Phil, do you want to talk a little bit, given that, I think the difference between the two firms here is pretty stark. So, maybe less K1s in your...
Yeah, so we work predominantly with like the accredited investor, like the 1 to 5 million AUM, and so we have some private investments we offer, but that's usually for a more limited audience. So most of the work we do in alternatives tends to be on the liquid and semi-liquid side. So there's been a lot of innovation in fund structures around things like interval funds, tender offer funds, private BDCs, private REITs. Like illiquidity is not like a binary, like daily liquid ETF or 10-year lockup. There's some semi-liquid strategies that fit in the nice middle ground that I think are a bit more appealing to your, call it, average investor that doesn't want that really long lockup, doesn't want the tax headaches, likes the more frequent subscription opportunities, like whatever the case may be, just to make the experience more client friendly and more likely to adopt.
And there's more popping up every day.
Yeah.
There's so many of them popping up.
Abby, how do you help clients or advisors, I guess in this case, get comfortable with locking their money up for such a long period of time?
They need to really understand it. I mean, the key is really making sure they understand that illiquidity premium, right? You're getting that premium in most cases because your money is locked up for a period of time. So it's more about making sure the advisor really understands what they're doing for their clients. And I know that, many advisors have been burned in the past over perhaps some alternatives that they probably didn't do their due diligence on, which may have scarred them a little bit. So getting them to even think about it and then really educating them and giving them the confidence they need to properly be able to speak about it to their clients is just part of the challenge, I think.
Bryn, when you were talking about the way that you allocate to the more liquid side of your portfolios, I think it's kind of interesting, the J curve that you kind of go for. It's less of the longer term. You're looking for more cash flow oriented. How do you think about that?
So before I answer that, I think as trying to build out what am I going to do in the alternative space, you want to think, number one, what am I solving for? And then who am I solving it for? And so we have like our own process and philosophy, and I'm a big believer in the public and the private markets. What you don't own is just as important as what you do own. So we have a list of things that, in general, it's not like it's a parting of the Red Seas that we can't do it, but in general, we don't invest in 10-year funds. You have to have a really good reason to lock up someone's money. Why wouldn't I just buy the Qs or SPY for 10 years and call it a day? Right? So really good reason. We don't like the J curve. I think that's a bad client experience where they take 5 years to call your money and then the clients are down. And then in 5 years later, the client's like, am I made money yet? So quarter after quarter, year after year, clients still don't know how they've done. And so our clientele are mostly entrepreneurs that have sold a business. And so if you think about that, what are they solving for? They don't have a W-2. And as you guys know, post GFC, you can have a $50 million balance sheet, but if you can't get a mortgage if you don't have a W-2, right? And so what we're trying to do is rebuild that cash flow. And so I took a look the other day. We've allocated over the last 5 years since we started the firm to 700 million. We've committed 700 million in capital. 61% of that is in private credit and 14% is in real estate. So that the majority of that or all of that's cash flowing investments. And so we can build out a cash flow for our clients, a cash flow, using our technology to say, here, as they call the capital, you're going to start getting this amount of money each quarter and then recreating that W-2 wealth. And so then that also allows us in the public markets, let that money grow. Right? So then when the markets are selling off, they're much less worried about that because they've been recreated this other cash flow. So I think we look at it a little bit differently because we're not investing in alternatives for diversification. We're doing very specific cash flow or growth, what have you. But diversification, to me, I can get in the public markets without all the headache of K1s and illiquidity.
I'd love to maybe sticking on the theme of diversification a little bit. When you look at the private markets, especially just because of the mark-to-market not occurring on a daily or minute-by-minute basis, depending on what you're investing in, I think there's this misperception that, well, it's less risky. I can invest in private credit, and it's less risky than public credit. I guess as you educate your clients, and Abby, for you educating advisors, how do you educate them on risk and thinking about risk maybe a little bit differently in the private markets than in the public markets? Phil, maybe I could start with you and we can work our way down.
I think first we want to walk them through like the probably under appreciated risk in like the traditional portfolio where the dominant risk is that equity risk. Even if you're in a 60-40 mix, you're getting 90% or more of your risk coming from that stock piece. And then also the realization that we're all experiencing this year is that bonds are not necessarily a silver bullet in all environments to diversify stocks. And so I think that opens up the potential for other diversifying assets to really, again, address that risk management component to alternatives.
Abby?
Yeah, I mean, we don't work with the retail client. We only work with the advisors.
Sure.
But I will tell you that we do look at the trends on the platform and we take a look at where is money coming out of in order to go into alternatives, which kind of gives us a little bit of a trending that we can follow on a regular basis. And right now, I've been running this one question survey on our platform for the thousands of advisors that log in every day. And they have to respond with, in light of economic and financial conditions, are you A, increasing your allocation to alternatives, B, decreasing your allocation to alternatives, or C, maintaining? So I would say that over 70% of those that responded are increasing their allocation. But if you dive into it another level down and ask them, where is the money coming from that you're investing into alternatives? A lot of it is new money coming in. So it's new assets from either existing clients or new assets from new clients, or it's fixed income.
Yeah, I think the fixed income is such a big part of the quotient that hasn't been solved for, because you still have, clients with long duration, which so many clients had over the years, because the 60-40, I think for the last 10 years, people would say, well, it still works. And I still think with the yields at this level, you're still not going to get that return that you're looking for. And so we still find wonderful opportunity in private credit. And I want to talk about the education in a second, but on private credit, if you think about it, the banks have really been anesthetized since the great financial crisis. The banks were doing all the stuff the private credit's doing the past 10 years, the banks have been doing those for the previous 30. Well, they can't do anything now, right? So it's now all the private firms. And so you've seen private credit grow because they're doing all of that really good business. And so I think that's probably a challenge for the banks multiples long term because they just can't do anything. But that's where you're getting wonderful opportunity. On the education perspective, we do two things. And once again, the public markets and private markets are interlinked. They're part of the whole portfolio. And so one of the things we do, because we don't do hedge funds, or we don't do the hedge fund structure is just a structure. What we don't do is we don't put public securities in a liquid structure. I just think they're expensive, it's opaque. I would rather educate our clients about how volatility is returned in equities. So for example, I think the most dangerous phrase in our business is average returns. We never use it, it's terrible, and here's why. So from 1929 to last year, which is like almost 90 periods, the S&P has done about 996 per year. So in those almost 90 periods, how many years is the S&P, and I'll be liberal here, done between 8 and 12% in 90 years? Anyone want to guess?
Somebody guess.
Not Kevin. Okay, you get the trinket. It's 4. So in 90 years, the S&P has only done between 8 and 12%. People, we all the time. I mean, I don't say it, but I mean, I hear people say, "Oh, this fund has done X amount for 20 years, so you should expect that." And then on the other education side, so we talk a lot about that to clients, so they can sit still and be in their seat and say, just be in equities and don't tie your money up. But if you need that cash flow or you want a better return, we have some. This is what we're doing. What we're doing, though, as an idea, is we do private podcasts where we interview the managers that we're invested with. And so there's a way to get it on iTunes where it's not public, and all of the funds we used are already closed, so we're not marketing, and we control who we invite. And so our clients, they do, like my partner Doug and I interview them 25 to 30 minutes. You forget what you bought, especially on private investments. And so they can go in their car and just listen for 20 or 30 minutes, like, oh yeah, we bought this fund, this is what they do. So I do think if you're gonna be in the space, go all in and think about how you can educate your clients, not only on the publics, but the privates, and the podcast has been a good way for us to solve that.
That's a great idea. I love it. I love it. I mean, we do a lot of education with the managers. When we launch funds on the platform, they have a page on the platform. We have, interviews with them, podcasts with them, but bringing it down to the next level where the client can listen, that's a fabulous idea. Joanna, write that down.
I'd love to spend a little bit of time talking about vehicle. You all alluded to it in some of the opening remarks, but we've seen this evolution from the drawdown structure, the traditional LPGP, to liquid alternatives in the mutual fund space, which I know, Bryn, you have some strong views on. We'll get to that. And then, kind of that in between with the interval fund structure, evergreen structures, and so on. And it seems like there's kind of a two-part education gap there. There's the asset class and understanding the underlying securities, the strategies there. And then there's the whole vehicle conversation as well. And the vehicle conversation seems to be a trouble spot recently just because of how many are out there now. So maybe I'll open it up, whoever wants to take it first. But what are your thoughts on taking the drawdown structure and kind of democratizing it through these more liquid wrappers? Pros and cons to either one.
I can start. I mean, we'll start with interval funds. Like, the pros there, I think, are obvious, and that really the only key difference to like a mutual fund is the liquidity profile. So it has a lot of the same features that most investors are just kind of familiar and comfortable with. I would say that benefit is also a potential negative, though, at times, because it looks so similar to a mutual fund. There's the risk that an advisor or a client doesn't really quite understand what they're putting someone in, which is fine most of the time. But if there's a situation where gates go up and people can't get their money out when they want it, that can be a big source of friction. So I think there's got to be a lot of education on the front end on the structure because it is so similar. Now something like a tender offer or private RE, because it's subscription based, there's less chance of that kind of slipping through the cracks. But so I think there's a balance to it.
Anyone else?
I agree. I mean, I think that's really on target. I don't know if you think about it. You don't really use the other structure, the liquid.
Well, we could, right?
Yeah.
I mean, we could. We just choose not to. But I do think the interval funds are interesting. Like, once again, they're a wrapper. I would go back to who's the jockey. That's all I focus on, right? The wrapper does democratize it. And I think that's really important. But you want to know who's behind it. I will say where I think on the liquid side, my partner and I, structured products, I was at the wirehouse for 15 years, are super popular at the wirehouses. And, the advisors, the clients say there's no fee, but actually there's like a 2% embedded fee inside that structured product. And then they're illiquid. And then there's these triggers where the advisors can actually, on the same $1 million, make 2% 3 or 4 times a year. It's kind of crazy. And so, we custody with Fidelity and Schwab. They have those same structured products without the expenses. But what we've really been looking at, I mean, I'm an investor myself because we want to invest our money first, where we think that the liquid space on the structured product side has become so interesting is, there's a group, Innovator ETFs, super smart guys, and they do it in an ETF, and you have liquidity, and then if you want to hedge and say, well, I want 9% downside protection, but then I'll take 24% upside for 1 year on the S&P. They do that in a liquid ETF wrapper. So I think that's like clever way where we evolve the strategies with smart people behind it. And so I'm very open to things like that because I like the jockeys, and I think I'm really familiar with the option strategies. So I think that's really an exciting, part of the business on the liquid side that we're doing a lot more.
I would
thinking
add,
about.
I would add to that, and I agree with you. So we have a structured solutions platform as well. So we have our alternative investment platform, but then we have a pretty robust structured solutions platform, structured products. And we have seen tremendous growth in that business, not only year over year, but over the last couple of years, and more recently in the last quarters. And I think that having the ability for the advisor to also see what's coming up and being able to trigger some type of activity there is important for continuity purposes for the clients as well. So you raise, we don't think of structured products sometimes when we think about the broad basket of alternative investments, but it really is an option. Are you guys using them at all?
We do not, no.
Okay.
Phil, you're a big user of the liquid alternatives complex. How do you kind of pick your battles in there? Maybe just talking generally about kind of the evolution of the hedge fund strategies into this wrapper. We saw this happen over 10 years ago. Seems like a lot of those have fizzled out, but seem to have found some spots where it makes sense.
Yeah, I think there's like any asset class, like you could say the same thing about like large cap growth. There's good funds and there's not so good funds. Same with liquid alts. Like in aggregate, they've disappointed, but you're not buying every single fund in the universe. Obviously, you got to roll your sleeves up and really understand what you're buying, what the strategy is. And so, we tend to kind of like the analogy of like the jockey. We're kind of more betting on the horse, I guess, because we're looking for like these alternative like betas, if you will. I feel like the horse does all the work in the race. So you should probably get more credit. But
I think the jockey would
it's
disagree.
kind of true, but
yeah. But anyway, so it's really looking for like more like systematic kind of quantitative or sort of like just owning a market. Like an example being like catastrophe risk premium. Like you're not looking for alpha there. You're just looking for this uncorrelated return source. The same could be said for something like managed futures, where you're just looking for that trend following, beta. So that's kind of how we think about it in the liquid space. My mic go out?
Yeah, you're still coming.
Okay.
I just want to remind everyone we probably got a couple more minutes, and then we want to take questions. So.
there's some already coming
Yeah, there's
in.
some that are coming through, but feel free to submit them.
Aaron, your car alarm keeps going on.
I know. I'm sorry. We talked a little bit about taxes, but maybe we can finish up before we get into the questions on fees. And I think we've seen, especially over the past couple of years, this move to low-cost indexing, ETFs on the public side, and now we're being introduced to these asset classes and strategies that have fee structures that are much higher than what you might find in the public markets. Bryn, Phil, especially, and Abby, I'd love your thoughts, maybe from a broader advisor adoption. Fees, what's the way that you approach both educating clients on fees, but maybe the fee budgeting process?
So we have a fee budget. We don't write it down like we have a fee budget. We have part of our process is fees matter. And so once again, we don't distinguish when we're thinking about a portfolio, public and private. It all comes together. And so we can give clients a wonderful portfolio of low-cost ETFs, tax efficient, at a very low cost. Because we know on the private side, especially the QP side, we're looking at, 1.5 and 15 or 2 and 20. And so we try to, come in size, or like if you're with a Kaiser Capital, they're coming in size, and so the fees can be lower. And so you just know if you're going to be in this alternative space, the fees are just higher because it's harder to do. Like if you're in the real estate space buying multifamily apartments and then it just costs more than putting together 500 securities and wrapping it and calling it the S&P 500 index fund. And so we put together a fee budget and then talk to clients through that about you're not paying for beta here. You're paying for your alpha over here, and it just costs more. But then our fees though are lower though. I think our business is high, and so no one's ever going to get bonus from a client for high fees. So we actually have a lower fee, I think, relative to the industry, just because we don't ever want to have that conversation with a client.
Right.
So we just go low and then try to give wonderful service, do cool stuff like podcasts, have great managers, don't mess it up on the public side, and then just repeat that.
Easy.
Yeah.
Phil?
Yeah, I would say like on the tax side, like it's certainly a little bit more complex. Most alternatives are generally not the most tax efficient. So asset location certainly comes into play more in trying to optimize holding certain strategies that are either high income distributions or high turnover inside of a tax deferred account. Or if you don't have that flexibility, then just having a higher sort of hurdle to allocate to, knowing that if you're going to own it in a taxable account, you got to think about your after tax results, not your pre tax. And then from a just overall cost standpoint, that's probably like the biggest educational hurdle that we have when talking to clients about alternatives, because the way we approach things in the rest of the portfolio is really more index based and factor based, and those tend to be very, very low cost funds, and so that's what folks are accustomed to. And so when you present something that's got a materially higher expense ratio, you've got to like justify it and get the client to understand why you think the net benefit of those costs will be worthwhile. No, so there's it's not as simple as, okay, high cost bad, low cost good. Sometimes the lowest, especially in alternatives, sometimes the lowest cost option is not the best solution, whereas maybe that's more appropriate for like a traditional kind of market beta type of exposure.
Abby?
I mean, it's hard for me to talk about fees in a practical standpoint, because theoretically, CASE was launched to be able to reduce fees to allow for greater access to these types of products. So, we do a hard negotiation with every fund that comes on the platform. If there are any funds here, they'll tell you that, we really do work with them to try to get the greatest opportunity available for the advisors that honor us with giving us their services. So they range, there's a range, but that's why we exist, to kind of do that democratization on behalf of all independent advisors.
Great. We do have a couple questions that have come in during the session, so I'll just kind of go in order as we see them. Phil, what is the typical alternative allocation as a percentage of the overall portfolio for your clients at Savant?
I would say it partially depends on like liquidity preferences they have. So we have some clients really want all daily liquid, and so those have a smaller total alt allocation, maybe like 10 to 12%, and that's just focused on liquid alts. And then for clients without that preference or need, that opens up the door a little bit more. So we have a couple other asset classes that get introduced. That's usually more in the 15 to 20% range. So really kind of based on liquidity. And it's interesting. It's like that was a big reason for writing the book, is like it's not like we're investing half the portfolio in alternatives. But in my experience, it was like that 15 to 20% that was accounting for like 80% of the questions in client review meetings. And there was just these two education gaps that I think really needed to be filled, both from like our research teams and to our advisors, and then getting them comfortable and conversant enough to translate it to their clients, because they're the ones ultimately on the front lines day to day. So
I'm glad you could work out your frustration in the form of a book.
There you go. Just to add to that really quickly, I mean, so we have a line of sight into seeing like what percentage of asset allocation is being made to alternatives through our independent broker-dealer clients, right? So we serve a lot of independent broker-dealers that have thousands of advisors underneath them, and they use CASE for their alternative investment platform. And they let us know when they decide to increase the percentage that they'll allow their clients to invest in alternatives. And just this year, I would say there have been a handful of very, very large independent broker-dealers that have increased that percentage of allocation and empowered their advisors to go to a much higher, not a much higher, but let's say from 15 to 25% of the clients can be invested in alternative investments.
just one thing I would add there too, like I mean, that's how we do it at Savant. There's no right answer for what an alternatives allocation should be. My general definition is it's got to be enough to matter and make a difference to the portfolio, but not so heavy that you're going to introduce behavioral risk to the portfolio and create a situation where the client can't stick with it. So it's got to be enough to matter, but also not.
And it's going to depend on the client too.
Right.
Yeah.
Brand, do you have any thoughts on that?
I mean, we're like 40 to 50. We're 40 to 50%. I would say maybe 30 on the low side. But once again, we're solving for cash flow. We're not doing.
Yeah.
We have one VC fund, and it's a gaming fund, and so we look at it different, and so we do have those much higher allocations. And we have clients with bigger balance sheets that they're already at retirement. They've made it, right? And so they want that cash flow. They don't actually like the public markets, and that's what I see all the time is, people don't love the public markets. They just tolerate them because that's the only way to earn a return. And so if we can give them good cash flow on the private side, they're they're very happy having 30 to 50% in alternatives, especially like in a March of 2020 when people want to sell everything. You're just like, look at your whole balance sheet. You're just fine, so.
Abby, maybe a question for you because you work with a lot of the custodians.
Yep.
How do you see the custodians evolving in terms of offering alternatives directly? I know there's some, but your thoughts there?
It's hard. There's challenges. I mean, I've worked for a lot of the biggest custodians, and there's challenges operationally for them with processing alternative investments. There's challenges in connecting technology that may be legacy technology that's been around for a long time. Alternative data is also really hard to bring into other systems. So, I mean, we work closely now with all the major custodians. We just announced a much deeper integration with Pershing. So for advisors that custody with Pershing or any other independent broker-dealers, we've created true integration with their back office systems so that an advisor could go through NetX 360, see anything on the case platform that's available to them, transact one time, not have to do multiple transactions, digitized transaction process, and then shows up in the client's portfolio in their performance reporting. So we're making headway. I don't think custodians, I think it would take them a long time to do it themselves, just knowing the pace with which they build technology solutions. So that's just my guess.
Bryn, this related question that somebody asked on the technology that you mentioned that you use to execute on an alt strategy. Can you elaborate on that?
Yep. I mean, we do full balance sheet reporting. So we use Adapar for the full balance sheet. I will say that our team was having growing pains from the privates, the subdocs, PPMs. It's a pain, right? So if you want to go into that realm, it's a pain. And so this year's been like a huge difference. We've onboarded Subscribe and then Affirm Arch, which, Arch is going to be a game changer for us in terms of having a client portal, all the K1s, all the capital calls, like all this really cool stuff that helps our team efficient and is actually going to be a bonus for clients because it's going to make, once again, that transparency so much there. So if you're an RAA trying to actually go into, I'll say the K1 world, you have to have a platform to help you do it. It's just too much of a burden on a team.
The documents and the data.
Yeah.
It's like that is the biggest burden for alternative investments, for sure.
Maybe a final question. I think we're at time.
We just got kicked off.
just got
the
kicked
questions
off.
disappeared.
Okay. Well, maybe we'll just wrap up there. Thank you to all the panelists
Thank
for your
you,
time.
Aaron.
Thanks, Aaron.
Thank you all for being here.
Thank you, everyone.
Thank you.